Most retirees pull from their accounts in the wrong order, and it costs them. The right withdrawal order is counterintuitive, but the math saves the average retiree $50,000 or more in taxes over a 20-year retirement. On screen, $50,000 saved, withdrawal order. If you're 60, 65, or already in your 70s, this is specifically for you. You don't just need retirement income. You need income that does not trigger extra taxes, higher Medicare premiums, or bigger withdrawals later. We're answering 4 questions. Which account comes first? Why taxable first, Roth last works? How Social Security changes the math after the $44,000 married threshold, and when Roth first becomes smarter. Now, here's where it gets interesting. The best withdrawal order is not about which account has the most money. It's about which dollar creates the least tax damage. The standard order. The standard retirement withdrawal order is simple. Taxable account first. Traditional IRA or 401k second. Roth IRA last. On screen, 1. Taxable, 2. Traditional, 3. Roth. Here's why this works. Your taxable brokerage account has already been funded with after-tax money. When you sell investments, you do not pay ordinary income tax on the full amount. You only pay tax on the gain. In many retirement years, long-term capital gains get taxed at 0% or 15%, depending on taxable income. That gives you control. If you need $50,000 for spending, and $35,000 comes from selling high-basis investments, your taxable income rises only by the gain. Your traditional IRA or 401k works differently. Every dollar you withdraw is generally taxable as ordinary income. Pull $50,000 from a traditional IRA, and you've added $50,000 of taxable income before deductions. That income stacks on top of pensions, Social Security, part-time work, interest, and dividends. Your Roth IRA is the cleanest account. Qualified Roth withdrawals come out tax-free. They don't increase provisional income for Social Security. They don't increase adjusted gross income. They don't push you into a higher bracket. That's why Roth money is usually the last bucket you touch. Most people stop here, but there's one more thing. Taxable first, traditional second, Roth last, is the default order. It's not carved in stone. The real goal is to keep taxable income inside the right guardrails every year. Why the wrong order costs so much? Here's where retirees get stuck. They look at account balances and say, I'll just pull from the IRA because it's the biggest account. That feels normal. But it creates a tax trap. On screen, IRA withdrawal equals ordinary income. A retiree needs $50,000 this year. Option 1. Take the full $50,000 from a traditional IRA. That $50,000 is taxable ordinary income. Option 2. Take $30,000 from the traditional IRA and $20,000 from Roth. Now only $30,000 hits taxable income. That $20,000 difference sounds small in 1 year. Over 20 years, it becomes a 6-figure decision because it affects tax brackets, Social Security taxation, Medicare premiums, and future RMDs. Think of it like a pressure valve. Traditional IRA withdrawals increase pressure. Roth withdrawals release pressure. Taxable accounts create partial pressure, depending on the gain. A smart retirement income plan controls pressure every year. Social Security changes everything. But before we get there, you need to understand Social Security provisional income. For Social Security, the IRS uses a special formula. Adjusted gross income, plus tax-free interest, plus half of your Social Security benefit. On screen, provisional income equals AGI plus tax-free interest plus 1/2 Social Security. For single filers, once provisional income goes above $34,000, up to 85% of Social Security benefits become taxable. For married couples filing jointly, that threshold is $44,000. On screen lower third, provisional income greater than $34,000 single/$44,000 married equals up to 85% of SS taxable. This is where withdrawal order becomes powerful. Imagine a married couple receives $40,000 per year in Social Security. Half of that is $20,000. That means they only have $24,000 of room before hitting the $44,000 provisional income threshold. If they pull $50,000 from a traditional IRA, they don't just add $50,000 of income. They also push more Social Security into the taxable column. That's the hidden trap nobody tells you. Now compare that with a controlled sequence. They take $30,000 from a required IRA distribution and $20,000 from Roth. The Roth withdrawal does not count toward provisional income. It gives them cash without adding tax pressure. On screen, $30,000 IRA plus $20,000 Roth equals controlled income. In the right bracket, that keeps them around the 12% zone. But if they take the full $50,000 from the traditional IRA, that extra $20,000 can push them into the 22% zone. On screen, $50,000 IRA equals 22% bracket risk. That's $20,000 of extra taxable income, and in retirement, $1 can trigger another dollar of tax through Social Security taxation. The $50,000 difference. Let's compare two simplified 20-year retirement sequences. Both households start with the same mix, a taxable account, a traditional IRA, and a Roth IRA. Both need the same income. Both earn the same return. Household A pulls heavily from the traditional IRA early because it feels convenient. Household B uses taxable money first, fills the lower tax bracket with controlled IRA withdrawals, and saves Roth money as the pressure valve. On screen, IRA heavy first versus tax-aware order. After 20 years, Household A pays about $182,000 in federal taxes. Household B pays about $128,000. On screen, $182,000 versus $128,000. That's a $54,000 difference. Now, here's where it gets interesting. The correct move is not always avoid IRA withdrawals. Sometimes the smart move is to take IRA money on purpose. If you retire at 60 and Social Security starts later, you have a window with lower taxable income. That window is valuable. You can withdraw from the IRA or do Roth conversions up to the top of your target bracket. That reduces the future IRA balance, future RMDs, and future taxes in your 70s and 80s. The goal is not the lowest tax this year. The goal is the lowest lifetime tax. The Roth first exception. Now let's talk about the exception. Sometimes Roth first is the right move. Use Roth money first when this year is already a high-income year. For example, you sold a property, took a large capital gain, received a bonus, cashed out business income, or became widowed and moved from married filing jointly to single tax brackets. In those years, adding traditional IRA withdrawals makes a bad tax year worse. So Roth becomes permission. It lets you fund spending without stacking more taxable income on top of an already high-income year. On screen, high-income year? Use Roth as pressure relief. If the year is low income, fill the bracket with IRA withdrawals or Roth conversions. If the year is high income, protect the bracket and use Roth. That simple identity shift changes everything. You're asking, which account keeps me inside the best tax bracket this year? The tools and resources related to this video are linked in the description and pinned in the comment below. And thanks for watching. I'll see you in the next one.